Hi, I'm Jim Jubak and welcome to my YouTube video. I'm wearing my Friends Cup of Prague t-shirt today in honor of beer, which we should all go out and drink in this hot, humid last days of summer weather. Pilsner is the beer of choice, especially if you're in Prague. Anyway, if you want just more information, including 3 portfolios from me, you can get them on my free site, which is jubakpicks.com. Link down below. If you want 6 portfolios and more stuff every day, you can subscribe to my paid site, and that's jubakam.com. And again, the link is down below. Today's title is "The Market's Big Fear is the Economy." And for that, I think that's a fairly clear statement, and that clarity comes to us courtesy of the Federal Reserve yesterday. Not that the Federal Reserve was particularly clear, but what's interesting to me about yesterday's announcement from the Open Market Committee is that what the market chose to hear in that statement and what it reacted to. If you remember yesterday, a long time ago, I know, especially for those who are drinking beer, we had a really pretty good bounce back day in US stocks. The S&P was up 0.95%, the Dow climbed 1%, the NASDAQ up 1.02%, and the Russell, which has recently been the most sensitive to economic assumptions, was up 1.48%. The market could have chosen to hear the Fed talk about, well, you know, we're seeing inflation drop to 2.2%, even though inflation right now is running at 4.2%. I'm very, very skeptical. The market could have looked at the fact that the Fed sees GDP dropping to 5.9% in 2021 from 7%. The market could have chosen to hear the Fed say the median projection by a Fed official, now according to the dot plots, is 3 to 4 interest rate increases by the end of 2023, and maybe as many as 7 by the end of 2024. If the market had focused on any of that stuff, stocks would have gone down. But what the market focused on yesterday was the Fed saying, hey, GDP growth in 2022 is not going to go through the floor. It's in fact going to come out at 3.8%, which is pretty good for the US economy with all of its productivity problems. And in 2023, we're still looking for 2.3% growth. Now the market has clearly been worried about growth in the economy as a whole. This was incredibly reassuring. This is what the market focused on. So this is the clarity we have. The issue for the market going forward in the short term is economic growth and earnings growth. And you can see one of the problems here in the charts for Disney and Adobe. Now, the problem with the Fed projections is that they're just projections. So if the market makes the assumption and goes up on the basis of the projections, it builds in the possibility of disappointment when something really doesn't come through. And we recently had an example of that with Disney, where Disney went out and said, hey, you know, we're seeing growth of our streaming service, Disney Plus, drop off a little. So you had this huge plunge from here, 183 on the 17th, down to 171. That's a $12 a share drop on the 21st. It's since rebounded somewhat as the market has as a whole. But what we basically had here is Disney not saying, hey, earnings are going to be bad. Disney not saying earnings are going to fall off a cliff. What we're seeing is people were assuming, people being investors and traders, assuming that Disney's earnings were going to be growing at this rate, and they're only going to be growing at this rate, so therefore we sold off big. This is the kind of action I think we're going to see in the third quarter because, hey, third quarter earnings projections, earnings guidance from companies have been coming down due to the Delta variant, due to glitches in the global supply chain, due to various and sundry things. So the third quarter looks like it's going to be iffy, so I think we're going to see a lot of misses like this. Not misses in the sense of, hey, we're going to make a profit, now we're going to make a loss, but misses as in we're going to grow by 30% and we're only going to grow by 20%. You get the same thing in the chart of Adobe. Now, I'm going to talk about Adobe later in my quick picks, but Adobe came out and with its third quarter earnings last week and basically said, hey, our third quarter revenue grew 22% year over year. And the market said, 22%? Oh my God, only 22%? And we got this, blump, blump. And this is like what I'm, again, fearing for the third quarter, that 22% year-over-year earnings growth is, this is revenue growth, sorry. 22% revenue growth year-over-year is pretty damn good. It's not good enough if the market is assuming more. And I think that's what the market is assuming now. So what we've got is, I think, pretty good clarity from the market's reaction to what the market heard in the Fed's statement about economic growth, and therefore a possible setup for disappointment, not with overall economic growth, but with earnings growth in particular in the third quarter, where we've got a lot of companies revising down growth, cutting projections, etc., because of problems in the economy. If we see that in a market where everybody is worried about economic growth going forward, I think we're looking for some pretty big volatility in individual stocks in the third quarter. And I'd just like to remind you that that third quarter ends on the 30th of September, so we should start to see earnings reports from companies around 10th of October or something like that, starting off with the big banks. This is Jim Jubak. Thanks for watching. Remember, if you like this video, please like it. Subscribe to my YouTube channel if you'd like to get notification of when we're doing more. You can also see more of my stuff, including 3 portfolios for free online. That's at my jubakpicks.com site, link down below. Or if you want 6 portfolios and like to subscribe, you can subscribe at jubakam.com. Again, link down below. Thanks for watching.